Your paycheck hits your bank, and within weeks, that same money might be helping fund a mortgage, a factory expansion, a government bond, and a giant retirement fund you've never even heard of. And here's the wild part: most of the money moving around the financial system isn't physical cash. It's mostly promises, balance sheets, and institutions passing the same dollars around like a relay race. Today, I'm going to show you the entire financial system as one machine: who creates money, who moves it, who multiplies it, and who can blow it up. And in a few minutes, I'll explain the one place where money gets created in a way that sounds illegal, but is totally normal. Money feels simple when you're earning it, work to paycheck to bills to whatever's left. But behind that, there's a hidden world: central banks, commercial banks, pension funds, insurance companies, mutual funds, hedge funds, investment banks, private equity, venture capital, and they're all connected. Most countries operate a central bank of their own. Central banks do many things, but at their core, they have enormous control over the economy. If you don't understand the connections, the system feels like magic. If you do understand them, it stops being scary, it becomes predictable. By the end, you'll be able to look at any financial headline: rates, inflation, bank failures, stock rallies, and know which gear is turning. Think of the financial system like a giant machine with three layers: the rule setters, central banks plus regulators; the money pipes, commercial banks plus markets; the super pools, pensions, insurance, funds, massive investors. Now, let's walk through the gears. Central banks are the rule setters. Examples: US Federal Reserve, UK's Bank of England, China's People's Bank of China. Their role is mainly to guide three things: inflation and price stability, employment and overall economic activity. Financial stability, keeping the system from breaking. They do it mainly with interest rates and asset purchases/sales. When the economy slows, they cut rates, borrowing gets cheaper, spending and investment rise. There's a catch: extra money boosts demand, but it also pushes prices higher. When inflation spikes, they raise rates, borrowing gets expensive, spending cools. Then you've got the famous tools people argue about: quantitative easing. Central bank buys assets like government bonds to add liquidity. Quantitative tightening sells/lets assets roll off to remove liquidity. In a second, you'll see how this decision travels from a rate announcement all the way to your mortgage payment and your stock portfolio. Commercial banks are your everyday banks. Your paycheck hits this account, your bills get paid from it, and you may even take out a mortgage or car loan through the same system. Here's the simple idea: savers have extra cash sitting around, borrowers need cash to buy homes, fund companies, build projects. Banks sit in the middle, but here's the wait what moment. Banks don't only lend out existing deposits. When a bank issues a loan, it typically creates a matching deposit on its balance sheet. That's why banks are often described as money creators in modern systems. And yes, reserve requirements used to be a classic limiter. In the US, reserve requirement ratios were reduced to zero in March 2020. That doesn't mean infinite lending, because banks still face capital requirements, liquidity rules, credit risk regulation, but it does show why banking is the beating heart of money flow. Next, we hit the biggest pools of money on earth, so big they quietly finance entire industries. Pension funds exist for one reason: so people don't run out of money after they stop working. And because pensions collect contributions for decades, they become monster-sized investors. Globally, pension assets are often estimated around $60 trillion, plus depending on coverage and definitions. Pension funds are massive investment pools built to provide income after people stop working, so retirees don't run out of money. They don't just save in a basic savings account. Pension funds aim for about 6 to 7% annually by diversifying almost everywhere. They invest across stocks, government bonds, corporate bonds, real estate, private equity, and venture capital, often as major fund investors. For example, Ontario Municipal Employees Retirement System owns major assets like Hudson Yards and Olympic Tower in New York, along with large hotels in Canada, and it doesn't stop at real estate. Capital also flows into hedge funds, venture capital, and private equity. That's why pensions matter even if you're young. Your retirement system isn't just sitting there, it's powering markets behind the scenes. Mutual funds and ETFs are basically professional diversification for normal investors. Hedge funds are built for millions, but mutual funds open the door with thousands and a professional at the wheel. Thousands of small contributions merge into one massive pool, then spread across markets according to a plan. Two big styles: passive, lower fees, tries to match the market. Active managers try to outperform, often higher fees. This is the bridge that lets someone invest $50 or $500 without needing a finance team. Now we move from investing for everyone to investing with knives out. Mutual funds are open to the public, while hedge funds typically restrict access to accredited investors because they can use leverage short selling derivatives. Complex strategies, hedge funds can be insanely risky. They can bet on literally anything: assets going up, assets going down, interest rates, currencies, volatility, almost anything. Some perform incredibly, many do not. The key difference is flexibility plus risk. History shows that when greed goes too far, even billion-dollar managers can end up facing serious consequences. But hedge funds don't build skyscrapers. The next players do because they connect businesses to massive capital. Investment banks are the big deal engines. They wear a lot of hats, but investment banks really make their money in three ways: IPOs, mergers and acquisitions, and capital raising. First up, IPOs. Going public usually starts with a call to an investment bank. They price the company, manage the filings, and line up investors. That's how, in 2012, Morgan Stanley helped take Facebook public, pulling in roughly $16 billion in one day. M&A, mergers get messy quickly. Valuation debates, tough negotiations, and deep financial reviews are all required to avoid costly surprises. Investment banks step in with large teams to stress test the deal before real money is on the line. Raising capital. When a company needs serious money far beyond a regular loan, investment banks take over. They structure bond offerings, coordinate huge loans, or help sell new shares. At the core, their job is convincing investors to part with their cash, and they're very good at it. Their real superpower is distribution. They convince large investors to buy. Next comes the industry that buys entire companies, like their fixer-upper houses. Private equity firms raise money often from pensions and institutions, then buy companies, improve them, or cut costs and aim to sell later. A classic strategy is using leverage. Leveraged buyouts use a lot of borrowed money, often secured against the company itself. Sometimes PE creates real efficiency. Sometimes it creates stress. High debt loads can leave companies fragile in downturns. Blackstone's long-running Hilton investment is a famous win, often reported as around $14 billion profit by the time they fully exited in 2018. Now we go earlier than private equity into the world that funds companies before they're proven. Venture capital firms invest in startups. Most fail. A few win so hard that they cover the losers. That's the power law idea. You're not trying to be right often, you're trying to be right big a small number of times. That's why VC money often comes from large institutions that can afford the risk. Insurance companies collect premiums from huge groups and pay claims when bad things happen. Because claims are uncertain, those premiums pile up into massive cash reserves. Instead of letting the money sit, insurers put it to work, favoring bonds for steady returns while also branching into stocks, property, and private markets. Your money isn't just sitting around waiting for a claim, it's quietly flowing back into global markets. So here's the machine: central banks steer rates and liquidity, commercial banks move money and expand credit, pension funds and insurers pool trillions and invest it. Mutual funds slash ETFs give everyday people diversified access. Hedge funds take flexible, sometimes aggressive bets. Investment banks make huge fundraising and deal making happen. Private equity buys and rebuilds companies, often with leverage venture capital funds, high risk startups chasing massive winners. Together, they don't just move money, they create it, multiply it, price it, and sometimes destroy it. And whether you realize it or not, every paycheck you earn, every loan you take, every premium you pay, every retirement contribution you make feeds this invisible web.